Good afternoon and welcome. Thank you for joining us for the second Money Matters webinar in our series, co-sponsored by the Friends of the Sacramento Public Library and the Sacramento Public Library. The Friends are honoring Library Director Rivka Sass, who will be retiring at the end of this year. The Young Readers Fund is an endowment in her honor to nurture young readers in the future. To find out more about us or the Young Readers Fund, you can visit us and contribute maybe at saclivefriends.org. I'm Karen Wilson, president of the Friends of the Sacramento Public Library. Our Money Matters sessions held live at noon on Thursdays for the month of October. Here we go. Let me just, here. Our topics everyone needs to know more about. Coming up, protecting yourself from fraud and financial scams, followed by building a lasting legacy, how you want to be remembered. Our topic today is investment trends. Our speaker is Chuck Else. Chuck is a principal at Osborne Partners Capital Management, LLC. He has more than 25 years experience in wealth management. His responsibilities include serving as client liaison at Osborne Partners Investment Managing Team. That means he's very good at answering questions. So put your questions in the Q&A section of your screen and Chuck will answer them at the end of the program. If you need to access closed captioning, you can click on the live transcript button at the bottom of your screen. If you post in chat, your comments will be public, so keep them respectful. And a recording will be made of the Sacramento Public Library's of this presentation and available on the Sacramento Public Library's website at saclibrary.org later this week, and will be posted on the library's YouTube channel. So now, Chuck, we're all looking forward to what you have to say.
Well, thank you so much, Karen. I certainly appreciate it. And good afternoon, everyone. And thank you to the Friends and to the Sacramento Public Library for welcoming me here today. I certainly appreciate it. We've had a long history working with the Friends and the library here at Osborne Partners. It's been a wonderful relationship, and I couldn't be more pleased to participate in today's session. So, thanks again for having me. Without further ado, I'm going to share my screen here, and we'll jump into the meat of my discussion today, and then we'll be happy, as Karen mentioned, to take some questions from the audience towards the end here. So just to kind of familiarize you a little bit with our firm, so you know who we are. We're one of the oldest wealth management and financial planning firms in the country. We are headquartered in San Francisco, and we have been around since 1937. So we're coming up on our 85th year in business here at the beginning of next year. We have a team of chartered financial analysts that manage our client portfolios and analyze individual securities and capital markets. We also have a team of certified financial planners that work with our clients on a host of different financial planning topics. And I think most importantly, we have a very unique investment philosophy and discipline that I wanted to share with the group today. I think it's important for everybody to have an investment discipline when managing assets, whether you're doing it on your own or working with a professional. And so I wanted to walk you through our particular discipline and also share our current outlook on a number of different asset classes in which we invest on behalf of our clients. As of the end of the second quarter, we manage roughly about $2 billion in total assets. So we're kind of a mid-sized firm in the grand scheme of our industry. So to talk just a little bit about our approach and our philosophy, you know, we do deliver sophisticated investment management and financial planning services for our clients. I talked a little bit about our team and what that comprises. From a philosophical perspective, you know, we're a big believer that individuals, smaller institutions, foundations, endowments, all should have access to the same level of sophistication in the management of their assets as large pension funds, large university endowment systems, you know, things of that nature. But we try to do so without the side effect of higher fees. Oftentimes, many of these larger organizations are paying multiple levels of fees to various providers, higher volatility, little liquidity in some instances where people are managing assets in illiquid type investments, meaning you can't easily turn those into cash, and or poor tax efficiency in the case where taxable considerations need to be taken into account. So we achieve that, number one, by actively managing a diversified portfolio of multiple asset classes. Traditionally, when a lot of people think about building investment portfolios, they tend to think about stocks and they tend to think about bonds. It's a relatively, in our view, kind of simplistic approach. And we actually look at the world from a little bit broader sense, where we also incorporate additional asset classes, including things like natural resources investments, which you can think of as hard and soft commodities, so precious metals or agricultural commodities. Real estate investments. Real estate is certainly an important driver of our overall economy in the United States and globally. And we also invest in a number of tools for hedging purposes or trying to minimize losses in a portfolio. And one of the ideas behind that, and really one of the keys to our approach and a cornerstone of our philosophy, is that you don't need to take big risks in easy market environments. What is really more important mathematically to an investment strategy over the long haul is to try to minimize losses in difficult market environments. And one of the ways to do that is by blending a diverse portfolio of different asset classes that are going to act differently in different economic environments together into a portfolio, so that you, at any given point in time, have certain portions of your portfolio zigging and other portions zagging. You don't want everything going up at the same time. You don't want everything going down at the same time. What you're really trying to do is minimize the amount of volatility to try to, as efficiently as possible, continually be compounding the growth on your portfolio. So losing less in down markets is really a key to our basic philosophy and investment discipline. So to talk just generally, this is a kind of a snapshot of what a typical portfolio allocation might look like for our clients, and very similar to the allocation that we have been managing on behalf of the Friends of the Sacramento Public Library for years and years here at the firm. But most of our clients have some exposure to U.S. stocks, usually individual U.S. stocks, foreign stocks. We also buy individual securities in that particular arena. Fixed income, which is bonds or the bond market or other derivatives of the bond market generally, and those are typically individual bonds as well. Natural resources, I mentioned already, are really hard and soft commodities. We also think of that as energy and alternative energy. So wind, water, solar is an important component there. Alternatives. Alternatives is a broad term, but what we mean by alternatives is really hedging or trying to minimize some potential risk in our client portfolios, again, to try to guard against losses. Real estate, again, I mentioned, and then certainly cash is an important component and a risk management tool that can be very effective in times of great market volatility as well. Now, one of the unique things about our philosophy is that we see each of these asset classes as having a very distinct purpose in a portfolio. And I'll give you a couple of examples of what I mean by this as we walk through these slides together. But I think that, in a lot of instances, when people are thinking about the stock market, I think the vast majority of people are looking at stocks as a growth engine. And we would agree with that, both in the US as well as outside the United States. Really, our view is these are two of the primary growth engines to build growth and continue to drive growth in your portfolio over time. It's certainly one of the highest returning asset classes, both domestic and foreign equities over the past, call it 40 years or so. But also it can be a high risk investment. If you think about the financial crisis back in 2008, global stocks fell by nearly 50% in that environment. And that could be a stomach churning experience for a lot of folks. So in a lot of instances, it doesn't make sense to have 100% of your assets allocated just to the stock market, but it is certainly an important component from a growth perspective. One of the interesting things I think between US and foreign stocks is they tend to go through periods of leadership and then lagging one another that generally are measured in periods of about 7 to 10 years. And so if you think about the last 10 years or so, this has certainly been dominated by US stock returns, whereas foreign stocks haven't done nearly as well. If you backed up to the 00s from 2000 to really about the onset of the crisis, the financial crisis in 2008, foreign stocks actually outperformed US stocks pretty dramatically during that period of time. So it's important in our view to take a global perspective, because there's certainly not one best asset class in all market and economic environments. And I think it's important to be able to be flexible and have some exposure both within the United States and outside the United States. At the same time, you need to be cognizant of various risks that affect assets like foreign stocks. For example, the US dollar and the strength or the weakness of the US dollar can have a pretty significant impact on the returns that you might enjoy investing outside the United States. So that's one risk that we're very focused on in terms of what we believe the US dollar is going to do at any given point in time in a forward-looking sense relative to economies around the world. So growth comes from your equity allocation. And one of the other things I like to point out when I cover this particular slide is, we've been in an environment where interest rates are at absolute historical lows. You go back really over the last 60 or 70 years, and we've never seen interest rates this low. And for those of you that may be income-oriented investors, this can be a very frustrating environment because it's very difficult to find any kind of an interest-bearing instrument, whether it's a bond or a CD or a money market fund or a checking or savings account at your bank, that's really paying any kind of income. And I know that can be very frustrating. What you've seen in the press a lot over the last 10 years, given this very challenging interest rate environment for income investors, is a lot of folks tending to gravitate towards higher dividend paying stocks as a way of kind of supplementing or replacing lost income from their fixed interest or fixed income investments. We are, of the mindset that, with having a specific investment discipline, you don't want to necessarily look at stocks as an income generator for you. Certainly dividends are kind of a nice supplement to the growth that you might experience investing in equities. But, as opposed to just buying the highest dividend paying stocks out there, which generally tend to be in slower growth, more mature industries that, really don't grow much. Think about utilities stocks or telecommunication stocks like an AT&T or a Verizon. Those stocks really don't move much, but they do pay out a nice healthy dividend. It's not necessarily the best way to generate income. And I'll touch on a couple of other ideas here as we move through the presentation as to how we're helping our clients who are looking for income from their portfolios supplement that lost income, if you will, given how low interest rates are and the difficulty in generating those types of income streams from the bond market itself. But moving on, fixed income is certainly an important component of a portfolio, whether you're an income investor or not, as it really serves a couple of different purposes. Number one, it helps to generate some degree of income, some incoming cash into the portfolio if you're not utilizing your portfolio for regular living expenses or cash needs. It at least provides some income for further reinvestment to continue to compound the growth of your portfolio. But more importantly, in our view, it is a risk reducer. It helps to reduce the volatility of a portfolio, given that even in very dire economic scenarios, like the financial crisis in 08 and 09, bonds tend to have very little volatility on the downside. So, in 2008, as an example, while global stocks fell by 50%, bonds actually only fell about 5% in that environment, which helped to kind of cushion the blow in terms of a total return on a portfolio by having some exposure to less volatile assets like bonds in your portfolio. At the same time, you give up a little bit on the growth side of the equation with bonds. Bonds have not generated any total return greater than 10% over the last 20 plus years. Whereas stocks certainly have seen a number of 20% plus years, over that period of time. So, it's there to help reduce risk, and it's there to help generate some cash for further reinvestment and or for living expenses that you might need from your investment portfolio. Now, natural resources, again, hard and soft commodities, energy and alternative energy, These are an important inflation hedge in a portfolio, and you've probably heard quite a bit of talk in the press this year about the uptick we've seen in inflation. In fact, for most of you that go to the grocery store or anywhere out there right now, you're seeing it in terms of your bottom line and the prices we're having to pay, at the cash register. And generally speaking, commodities and other natural resources are going to be your best inflation hedge. They're going to perform well in a higher inflationary environment. And that has certainly been the case this year, where natural resources as an asset class is the best performing asset class, major asset class, I should say, of any of the major asset classes out there this year. Natural resources are up roughly about 30% this year. Whereas the stock market, depending on how you want to measure it, is up in the mid-teens this year. Bonds are basically flat this year, and real estate is up somewhere in the 10 to 12% range. So natural resources in this higher inflationary environment play a very, very important role in helping to defend against inflation and help protect the purchasing power of any investment portfolio. Now, one of the negatives when it comes to natural resources is they tend to move in very, very long cycles. So if you think about, for example, the last 10 years coming out of the financial crisis in 08, 09, that was a very low inflation environment. And one of the things that the Federal Reserve has been trying to do for the last decade or so is to try to stimulate a little bit more inflation in the economy, because we were running below their 2% target consistently over that decade. So when you get a very low inflation environment like that, natural resources are not going to perform well at all. If you looked at this asset class, in 2010, 11, 12, 13, et cetera, they dramatically underperformed other growth assets like equities during that period, because we weren't experiencing any real inflationary pressure in the economy. Fast forward to today, and the exact opposite is true. Now we've got some real inflation to deal with, even though we think it's a relatively short-lived event tied to the pandemic and some of the supply bottlenecks that we're seeing all over the globe, tied to the difficulties of the pandemic. But nonetheless, it is definitely an area that has helped to defend against this uptick we've seen in inflation. Now, I mentioned earlier that, if you're an income-oriented investor out there and you're really worried about the amount of cash that you can generate from your portfolio, that the bond market has been frustrating in this respect. And that's where real estate, and particularly real estate investment trusts, can play a very important role in helping to supplement some of that lost income. Real estate is one of the higher performing asset classes over the long haul, but it also tends to be one of the highest dividend yielding asset classes out there. In particular with real estate investment trusts, they are, to qualify for certain tax preferential treatment, are required to distribute 90% of their income in any given year to their investors. So that generally means they are generally pretty high dividend paying instruments. Now, real estate investment trusts can be one of the more complex investments to analyze and to properly value. But nonetheless, real estate generally can be a very beneficial asset class in a low interest rate environment, really to help generate better income into a portfolio. Again, you've got to be willing to stomach a little bit of volatility. They're certainly more volatile than the bond market generally is. But nonetheless, they could perform that goal of really generating better income into a portfolio in very low interest rate environments like we found ourselves in. And then finally, on the alternative asset side, alternative assets can mean a lot of different things in our industry. This is usually the realm of where people start talking about hedge funds and private equity funds and venture capital funds and private investments of all kinds. When we think about alternative assets, what we are really doing is trying to use liquid securities to hedge some risk that is prevalent in our client portfolios in some asset class. Now, usually that's volatility risk, the risk that the market's going to take a substantial dive. Currency risk, the risk that some big move in a currency like the US dollar and the impact it can have on foreign stocks, for example, is likely to make a big move, and how do we try to mitigate some of that risk? Or interest rate risk. And I think that that's an important one today, given that interest rates are so low, they really have nowhere to go but up from here. And if you're owning a bond portfolio, because bond prices and interest rates go in opposite directions, as interest rates go up, bond prices go down. And so if you're owning a portfolio of bonds right now, and the likelihood over the next couple to 3 years is that interest rates continue to creep up from here, that's going to put pressure on your bond portfolio in terms of the principal value of your bond portfolio. So that makes it a headwind, if you will, for bond investors. And so one of the ways that we try to guard against that is to actually hedge some of that interest rate risk, or remove that interest rate risk from our client portfolios for those folks that are owning bonds in their portfolios today. The whole idea of that particular asset class from our vantage point is to guard against significant losses and to reduce the overall volatility of a portfolio, particularly in cases like the Friends of the Sacramento Public Library, who are being depended upon to help generate regular cash to the Sacramento Public Library to help continue to fund the operations of the library, to provide all the services that we all love and enjoy, from the Sacramento Public Library. So hopefully that gives you just a general sense and an overview of our investment philosophy and our investment discipline, and most importantly, the purpose of each individual asset class as you think a little bit about your current situation and the various different types of vehicles and asset classes that you might own. And with that, I wanted to talk just a little bit about a few of these asset classes and our current views and our outlook for these asset classes going forward. Now, here I'm sharing with you a chart that is showing the United States stock market. Basically, on the top here, what you're seeing is the price of the S&P 500. Compared to the performance on a price basis of the foreign markets. So the S&P 500, the US market, is in green on the top, and the foreign markets are in blue. And this takes you all the way back to the financial crisis in 2008 on the left-hand side of this particular chart. And what you can see is coming out of the financial crisis, US stocks and foreign stocks were pretty much neck and neck until about the middle of 2011. And in 2011, US stocks really took off on a relative basis and a relative performance basis to the foreign stock markets. The foreign markets really didn't go anywhere, up until starting in about the early part of 2017. They began to make some headway. They, of course, got hit, as did US stocks, with the onset of the pandemic in March and April of last year. And since that period of time, the US has really regained leadership. Now, on the bottom part of this chart, what I'm showing you is just the relative valuation, looking at price to earnings ratios for these two broad asset classes. So US stocks, basically divided the PE of US stocks, or the S&P 500, divided by the price earnings ratio of the foreign stock market. And right now, if you look at the right-hand side of this chart, the US is currently trading at a 45% premium to foreign stocks. So the way to think about that is the average stock in the United States, for an investor to buy the average stock in the United States, you're paying a 45% higher PE multiple or higher valuation than you are for a similar stock outside the United States. Now, this is pretty extreme. In fact, we haven't seen this extreme of a valuation, a relative valuation situation, since really going back to right in the middle of the financial crisis, the global financial crisis in 2008. To us, what this basically means, even though we're not bearish by any stretch on US stocks, is that if you think back to my comments earlier, that US stocks tend to lead for about 7 to 10 years or so, and then foreign stocks tend to take over leadership for 5 to 7 to 10 years or so. We think we're at an inflection point here, looking at relative valuations around the world today, where if you have a view of over the next 3 to 5 years, or you have a time horizon, an investment time horizon over the next 3 to 5 years, the likelihood that foreign stocks outperform US stocks from here, we think is very high. That's not at all to say that we're just selling all of our US stocks and putting everything into foreign stocks at this point. But from a prudent portfolio management perspective, we are slowly reducing some of our exposure on the US equity side of our portfolio and slowly adding more exposure outside the United States to try to buy similar earnings growth outside the US, but at a much lower valuation than where US stocks are trading today. Now, within the US market, I mentioned we're not at all bearish. We're not just selling all our US stocks, but I think it's important to understand there's been this ongoing argument between growth investors and value investors within the US market. And maybe to just define those two terms, growth stocks generally are the higher growing stocks out there. So you think about things like technology or biotechnology, things of that nature that generally are higher growing industries and have higher growing companies, where generally they will command a higher PE multiple. People will pay up more for that growth, and therefore they command higher valuations. The counterpoint to that are value stocks in the United States, which generally are in more mature industries. They're generally a little bit more slower growing industries or companies. And as a result, generally investors are willing to pay lower PE multiples, lower priced earnings multiples, or lower overall valuations for those types of companies. Now, in our view, growth is not better than value and value is not better than growth. We tend to be style agnostic and really look to where can we find the best risk reward situation at any given point in time. So in other words, where can we find investments where we have the least amount of downside risk, but the most amount of upside risk? And a lot of that comes from the work that we do in breaking open company balance sheets, income statements, cash flow statements, and really trying to determine what we think the true value of a company is, and then trying to find opportunities where we can buy companies for one reason or another below that true valuation number. Well, if you look at where we are today, we're finding a lot more of those opportunities in value-oriented companies and industries. Another way of saying that might be economically sensitive companies and industries versus some of the bigger growth names out there. Think, the FANG stocks as an example: Facebook, Alphabet, Amazon, Netflix, Apple, etc. Those are all great companies. We certainly believe in them long term. We hold many of those names as long-term investors in those names. But we have been reducing some of our exposure to those primarily because of this particular chart. If you look, this is very similar to the chart that we just covered, looking at the US versus the foreign markets, but this is just inside the United States, and looking at growth names, growth industries versus value companies and value industries. And right now, growth is trading at a whopping 79% premium on a valuation basis to value-oriented or more economically sensitive companies. You might think of value industries as things like materials companies, industrial companies, the banks all generally fall within that particular categorization as well. Even energy companies at this point, many of those would be considered value companies. Well, they are trading at very, very substantial discounted valuations versus their growth brethren in the market. And to us, that spells opportunity for those more economically sensitive areas. For those of you that may have turned on CNBC or Bloomberg Finance this morning, you may have seen that, for example, Bank of America just posted some very, very strong earnings. And, it's these economically sensitive areas, the banks, You might think of things like gaming stocks or online travel companies that have been very, very much negatively affected by the pandemic. They're very tied and very sensitive to what's going on in the economy. And as a result, their valuations have been depressed because of the pandemic itself. Well, as we come out of the pandemic, and we're hopeful that we're beginning to see some light at the end of the tunnel there. Many of those areas we think actually are poised to perform much better than some of these larger growth names, like the big tech names that a lot of folks have piled into here during the pandemic and during the stay-at-home phase, if you will, of the pandemic. So it's always important to understand from a valuation perspective, what are you paying and what are you getting in return for that in terms of earnings growth or dividend yield or free cash flow growth and things of that nature that we pay very, very close attention to here in any individual investment that we're making for clients. So hopefully that gives you a general sense of how we're positioning clients within the U.S. equity market. I want to talk a little bit more about natural resources as an inflation hedge. As I mentioned earlier, this generally is an area that's going to perform very well in a higher inflationary environment. So go back to the left-hand side of this chart, starts all the way back in 2006. We were experiencing higher levels of inflation in 2006 and 2007. As you can see here by the purple line, which is the consumer price index in the United States. And as a result, commodities generally were performing very, very well in that environment. Then comes the financial crisis in 2008. Then comes a very low inflation environment. As you can see, that purple line dropped substantially in 08, 09, and never really recovers dramatically beyond that, where we kind of averaged, maybe about 1% inflation in the United States for about a 10-year run there. And as a result, commodities did not perform well at all, as I mentioned earlier. You can see that green line just kind of continues to deteriorate for about a 10-year period until about the middle of last year. And then all of a sudden, we started to see some of the supply constraints brought about by the pandemic and the shutdowns. That's continued today, certainly with the spike of the Delta variant and the impact that that's having around the world. For those of you that are focused on the media at all, you've probably seen there are over 70 cargo ships sitting off of the coast of Long Beach and LA right now, primarily because there aren't enough laborers to unload those ships at the Port of LA and the Port of Long Beach. And that's creating significant supply constraints. And as a result, it's also creating inflationary pressure in the economy itself. Well, you've seen that inflation spike here pretty dramatically in 2021. And along with it, the price of commodities. So I think that this is just a great chart to show that, commodities can be in the right inflationary environments, a very, very effective tool to try to counter the effects that inflation can have on your investment portfolio. This is something we anticipate will continue at least into 2022. Certainly, it's going to take some time for a lot of these supply bottlenecks to work their way through the system. I think it's going to be interesting to see how the holiday season plays out. We're already hearing, at least anecdotally, the notion that a lot of us that are looking for various consumer goods, toys, larger ticket items, things of that nature, it's going to be very difficult to find those at reasonable prices anyway, in time for Christmas delivery. So I think that continues to place some inflationary pressure on the economy, and that commodities generally continue to be a very investable asset class and a great way to hedge against some of that risk. Now, I talked about real estate as an alternative to your bond portfolio, or at least a supplement to your bond portfolio for those that are more income-oriented investors. And what this basically just shows is that REITs, REITs, real estate investment trusts, generally are offering much better yields than treasury bonds. That's come down some if you looked at really at the onset of the pandemic in the spring of last year, where you see that spike on this green chart. REITs generally were paying about 4% better yields or interest rates than treasury bonds. That's come down as a result of real estate performing well over the past year, but you're still able to get about 1.2% better yield out of a real estate investment trust on average than you can out of a comparable treasury bond. So again, it's a nice way to try to at least augment or bump up the income that you're getting in your portfolio, given the frustratingly low interest rate environment we're in today. And then finally, a lot of investors ask me, well, yeah, but what about high yield bonds? What about going lower on the credit quality spectrum and buying quote unquote junk bonds, as an example. And although we certainly do invest in junk bonds when they make sense, as a rule of thumb, what we look to in taking the kind of risk to own quote unquote junk bonds or bonds in very low credit quality companies is the amount of commensurate interest that they are giving us versus treasury bonds. They need to be able to justify that risk by paying substantially more in interest for us to be interested in that. And as a rule of thumb, we generally like to see high yield bonds paying at least 4% or more better than treasury bonds in terms of their coupon interest payments. Right now, we're at about 3.4%. So it's not terribly attractive to us. Where we were actually buying high yield bonds, again, was in the downturn in March and April of last year, where those yields spiked to over 10% better than treasury bonds. And the way to think about that is investors were selling their high yield bonds, worried that those companies might actually go out of business during the pandemic and default on those bonds and not be able to pay those interest payments. And as a result, it sent the price of those bonds down dramatically, and therefore the yields up dramatically. And so at that point in time, those became very attractive instruments to lock in some substantially higher yields than you might get by investing in treasury bonds or other more traditional types of bonds, even corporate bonds or mortgage or agency bonds. So to wrap that all up, I just kind of wanted to share with you, what this basically means from an investment philosophy and discipline perspective for our clients. Our goal is to really provide good, solid growth and equity-like returns for our clients without having to take the full risk of being fully exposed to equities. And so we can typically compare ourselves to something called the Morgan Stanley Capital International All Country World Index. That's essentially the S&P 500 for the entire globe, and takes into account all the various companies that are trading publicly around the globe. And the idea here is we want to basically match or beat that index over time, but take a lot less risk and not have 100% of our client portfolios in stocks. So by blending in some of these other asset classes, what you can see from this chart is we've been able to generate very similar returns to that particular all stock benchmark. But more importantly, when you look at some of the statistics like our average down year, we've been able to minimize in the single digits versus an average down year of nearly 16% for the global stock market. So experiencing a lot less volatility. Our maximum drawdown, the worst peak to trough experience any of our clients have had over time was certainly at the onset of the global financial crisis. And we were able to limit that to about a 60% drop relative to the global stock market, which it's certainly never fun to be down 30%, but it's a lot easier to recover from down 30 than it is from down 50%, where if you understand the math, if you're down 50%, you got to go up 100%, or you've got to double your money just to get back to where you started. And much less volatility with what's called the ex post standard deviation. Standard deviation simply is a measure of volatility, how much a portfolio is bouncing around. And the idea is you want to try and generate similar returns with as little volatility as you possibly can. And so we've certainly been able to accomplish that on behalf of our clients here. So with all of that, I certainly hope I've done a lot of talking. I look forward to answering some questions from everybody, but I certainly hope that gives you some insight on our particular investment philosophy and discipline, as well as gives you a couple of things to apply in your own particular situation, as well as our outlook on these asset classes today. So I'd be happy to take some questions at this point.
Well, thank you, Chuck. We do have a couple of questions to start off. Nefertari asks, where is the best place to start when you're investing for the purposes of a regular income if you have very little capital to start with? And as a follow-up, what about mobile home park real estate?
Interesting question. Okay, I'll take those two a little bit separately. I think, for those starting out and trying to build up some type of an income stream, I think, one of the best places is to still take a diversified approach with your portfolio. But I think that an interesting tool to do some research on and become familiar with is something called an exchange traded fund or an ETF. Now, ETFs give investors, particularly that don't necessarily have the time or the bandwidth or the experience to do individual company and individual security research, the ability to buy baskets of securities to get exposure to certain themes or certain asset classes or certain sectors or industries, or you can really kind of slice and dice the investment world with ETFs in a lot of different ways. The first ETF was actually first introduced way back in 1994, and that section of our industry or investable universe has grown dramatically over that period of time. And ETFs can be an interesting area where you can get broad exposure to an asset class. So let's say, for example, you're starting out and your primary goal is, I want to get some income. I don't feel comfortable in analyzing an individual real estate investment trust. So I'm going to go buy a basket of real estate investment trusts and try and generate similar income or enjoy the similar income off of that without having to pick and choose individual companies that I think might be the best players in that particular space. So I would certainly encourage you to take a look at ETFs. Now, on the mobile home side of things, that is what I would consider to be a true alternative investment. I think that is a very, very localized kind of an investment, similar to investing in just directly in private real estate around the country. It's very regionalized. You've got to know the dynamics of the particular market in which you're investing. I certainly do know a number of folks, including some good friends of mine, who have made a lot of money investing in that particular asset itself, mobile home parks themselves. But you want to be sure, if you're doing so, you're working with an operator who has a track record of managing those, of being able to really maximize and monetize the value of those investments, and somebody that understands things like occupancy rates and vacancy rates, and the likelihood of consistent income coming from the rents on those properties. That is a very specialized level of expertise, and I think it can be applied on a mobile home or RV park by RV park basis. And so if you're involved or engaged in that, you certainly want to be working with somebody that's got a lot of experience in that specific slice of that asset class, if you will.
Yeah, I think that question comes from a lot of us have been reading about this in the media in the last 6 months or so. And doesn't sound like a spot for a beginner. Is that what you're?
I would definitely say that is not a spot for a beginner. It takes a lot of due diligence to make sure you understand what you're getting involved with when you get into that particular marketplace.
Okay, thanks. Oh, we have a question from Faith, who asks, how should you invest your funds in an IRA account?
Well, it's interesting in an IRA versus a taxable account. It's a great question because it kind of depends on where you are in your investment life cycle. But one of the nice things about an IRA, particularly for those that have a little bit longer time horizon or may not be having to take required minimum distributions, if they're 72 years or older at this point, you can take a little bit more risk in an IRA because you've got a little bit more longer time horizon. You can also buy higher income producing instruments like REITs in an IRA without any adverse tax consequences. So for example, in many instances when we're managing portfolios for families here at our firm, they'll have taxable accounts, maybe a trust account or a joint account that are taxable, and a couple of IRAs for the two spouses. Well, that gives us as managers flexibility to put certain types of assets into their taxable portfolio and other types of assets that might not be as sensitive from a tax perspective into their IRAs or other tax advantaged vehicles, to really provide the best and most efficient or tax efficient management of their portfolios. So that's a great question. Generally speaking, you can put less tax sensitive instruments into your IRA. You can take a little bit more risk, experience a little bit more volatility in your IRA, particularly if you're not being forced to take distributions out of that, or depending upon those distributions for regular living expenses on a year-over-year basis.
And as a follow-up, Faith asks, and I'm sure people are wondering, how to become a client of Osborne, and is there a minimum? And maybe you could generalize that, or
well, sure. I mean, we're always certainly interested in speaking with folks that feel we could be of any help to them at all. We do start with a $500,000 minimum here at our firm. So, we're generally working with folks that have been saving and investing and building up their assets for a period of time here. It's easy to contact us. You can look us up online. We're just simply www.osbornepartners.com, and that's OSBORNE partners.com. And I'm usually the primary point of contact here at the firm. So please don't hesitate to reach out to me directly. You'll see our phone number there on the website, et cetera.
Okay. And in general, how would somebody go about looking for somebody to invest on their behalf?
I think there are a bunch of different, very good resources out there. For any of you, we actually were introduced to the Friends of the Sacramento Public Library originally by Charles Schwab and Company. Charles Schwab is one of the main custodians or brokerage firms that we utilize. And they've got a couple of neat tools where you can actually search for local investment advisors through their website. So I would certainly encourage you to look at that. There's another group by the name of Smart Advisor that also provides recommendations of local investment advisors that they've screened to folks that are interested in looking for that. So there's a number of different tools out there to do that. You'll find various top 10 lists and top 100 lists out there. And some of those you can kind of take a little bit with a grain of salt, because oftentimes they're more pay to play, if you will, scenarios where some of the firms that might show up on those lists have paid a fee to do so. But I think, as importantly as that is, speaking with friends and family and professional colleagues as well, to get a feel for who people have had their own personal experiences with, because I think this is a very individualized business. I see it very much as a relationship business. And certainly there are a lot of things we do on the investment and the financial planning side, but I think as importantly, if not more so, is the role that we play as a trusted advisor to our clients. And that comes from building a very strong and trustworthy relationship. And during periods of great difficulty in markets or great market volatility, that trusted advisor needs to be somebody that you're willing to take their advice, which can be difficult to stomach in some instances, because this can be a very emotional type of a relationship. I mean, we are all very emotionally tied to our money, and we don't like to lose money. None of us do, but markets will go down. And I think having somebody to talk to who has a demonstrated track record of helping clients navigate those difficult periods and having the difficult conversations that entails, sometimes telling you things you don't want to necessarily hear, is extremely important when you're interviewing for a potential investment advisor.
Right, thank you. And then Faith asked, just could you quickly go into exchange traded funds, ETFs, just a little bit more?
Sure. Well, exchange traded funds are interesting. A lot of folks would think of them kind of like mutual funds. If you're familiar with mutual funds, there's a lot of those out there as well. But there's a couple of different interesting differences between mutual funds, where you're pooling your assets together with other investors to get access to professional management and be able to leverage a larger pool of assets to potentially get better pricing deals, get better execution pricing and things of that in markets. An exchange traded fund works very similarly, except the differences being an exchange traded fund trades like a stock on an exchange throughout the day, whereas a mutual fund only trades at a closing price on any given day. So there's a lot more flexibility in when you might want to execute a trade on exchange traded funds, getting in or out. So you've got more liquidity in that respect. Number two, exchange traded funds are very transparent. So you can see on any given day exactly what underlying investments that exchange traded fund represents, what basket of securities it represents. Whereas the mutual fund world is a little bit less transparent in that they only have to show you 4 times a year on their quarterly reports exactly what is held inside that mutual fund. So it can be difficult to gauge between, on an intra-quarter period. If you're in the middle of a quarter, you don't know exactly what you might have inside that, Fidelity Growth Mutual Fund or whatever the name of it might be. Whereas with an exchange traded fund, you can pull it up online. You can see exactly what the underlying components are. And number 3, exchange traded funds tend to be more tax efficient because you're not sharing a cost basis with everybody else in the fund. You're buying it at your own cost basis, and therefore you're not getting hit with a bunch of taxes because other people might be buying or selling out of that fund at a given point in time. You get better control over any taxable implications that come from your exchange traded fund. So there's really 3, very, very powerful arguments in favor of ETFs over a traditional mutual fund.
Great, thanks. Okay, Susan asked, is there a difference of amount insured by different companies, i.e. Osborne, Edward Jones, E-Trade, or Robinhood? I know stocks are not guaranteed for insurance. I'm asking about insurance coverage for the company not going belly up.
Mm-hmm. Sure. Well, different companies are certainly going to carry different levels of insurance themselves. Now, if you are a nationally registered broker dealer with the Financial Industry Regulatory Authority, like a Robinhood or a Charles Schwab or a Fidelity Investments or what have you, each of those accounts is covered by Securities Investor Protection Corporation insurance. So every account is covered up to, I believe the current amount now is $250,000 per account. That's standard, and that's at the federal government level. However, each of those individual companies carries additional liability insurance, errors and omissions insurance, et cetera, relative to their own businesses. So, for example, in the case of Charles Schwab, they have a very, very large insurance policy with Lloyd's of London, where if, let's say, for example, Charles Schwab were to go under, that insurance doesn't necessarily help protect you because the reality is you own those securities, whatever you might own, that are on Schwab's platform outright in your name. So if Schwab goes under and you happen to own General Electric, you still own General Electric. You don't need to worry about what's happening with Schwab. But if somebody at Schwab tried to, let's say, engage in fraudulent behavior or tried to, steal some of your money that was held there, for example, they have very large insurance policies that they're holding to protect their investors against that type of activity. By and large, if you're owning individual securities or if you're owning exchange traded funds, regardless of where you have those assets held, you're less dependent upon the health of that particular financial institution because you still own those securities outright. What you really care about is what's the financial stability of what you're invested in specifically, not necessarily where you're holding them.
Okay.
I hope that helps to answer that question.
So, and then Susan had a follow-up question. I like Roths. Why are they not recommended more?
Well, we recommend Roths wherever we can to folks. We love Roth IRAs. It's actually one of the neatest tools that the government has allowed us to utilize in a very long time in this country. So we manage a lot of our clients in Roth IRAs. Now, clearly, depending upon your individual situation, Roths do have certain limitations. If you're, generating too much on an adjusted gross income basis, you may be phased out in the ability to participate with a Roth. But for those people that do qualify for Roths, we are huge proponents here. For those of you, as an aside note to that, for those of you that might have more of your assets in traditional IRA investments and maybe at or in the early phases of retirement, one of the things you may want to consider are active Roth IRA conversions. And what that basically means is if you have some taxable source to be able to pay the taxes on converting your traditional IRA to a Roth, we would encourage you to consider doing that. Pay the taxes if you've got a long enough time horizon, because once those monies are in the Roth, they're going to grow tax-free forever. The government's not going to force you to distribute any and pay any additional tax on it. and those can also be passed on to your heirs tax-free. So the Roth is a very, very powerful tool, not only from a wealth generation perspective, but also in terms of passing on and leaving a legacy to future generations as well.
Great. Okay. And then we have a question about fiduciaries. Maybe you just need to do a brief explanation of what a fiduciary is, but we have a question about, are you a fiduciary and what is the general range of fees?
We are a fiduciary, and just to define that term, a fiduciary in our business is somebody who is typically registered as an investment advisor with the Securities Exchange Commission. And a fiduciary legally binds us to put our clients' best economic interests first. Now, maybe the easiest way to describe this is to give you an example or two. For most traditional quote unquote stockbrokers that work for some of the larger broker dealers, whether it's a Morgan Stanley or Merrill Lynch or Wells Fargo Advisors or whatever the case might be, most of those firms are registered from a regulatory perspective with the Financial Industry Regulatory Authority. They are not legally held to a fiduciary standard. They are held to something called a suitability standard, which basically means in its simplest form, let's say I had two identical mutual funds that I could recommend to you. They're absolutely identical in the components of the underlying constituents of the funds. But one carries a 2% management fee, of which I can share in a portion of that if I sell that to you. And one has a 1% management fee, and I can't share in that. Well, under the suitability standard that applies to those registered with the Financial Industry Regulatory Authority, they are justified in putting you into that 2% mutual fund and taking a cut of that as a fee that they put in their pocket, as long as they can show that that investment strategy for that fund was suitable for you. For those of us that are registered with the Securities Exchange Commission as registered investment advisors and fiduciaries and held to a fiduciary standard, we would be breaking the law in doing that. We would have to put you into that 1% mutual fund because it's in your best economic interest to do so. So I think that's probably the easiest way to explain the difference between kind of the two sides of our industry. It's very confusing, I think, to a lot of investors, and the Financial Industry Regulatory Authority and their constituents spend a lot of money lobbying every year in Washington, D.C. to maintain that suitability standard because it means a lot of revenue to a lot of the big brokerage firms out there. Osborne Partners, our firm, has always been a registered investment advisor. We were one of the earliest ones to register as an investment advisor in the country, and we've always been held to a fiduciary standard. And so in that respect, we're required to be putting our clients' best economic interest first. And the only source of revenue that we generate at our firm is the management fee that we charge to our clients. And that management fee is typically 1% annually on the first 5 million under management. And that encompasses not only our managing of assets, but also complementary or comprehensive, I should say, financial planning services, where we're helping clients with tax planning, estate planning, reviewing insurance coverages. We don't sell any insurance products. Again, we have one source of revenue. But 1% on the first 5 million, and then 0.5% on any balance over 5 million on an annual basis. So really our incentives are aligned with our clients. We're trying to grow their portfolios, and as a result, our revenue stream grows accordingly. And in difficult market environments, we're trying to protect our client portfolios, again, utilizing our investment philosophy and discipline and expertise to try to minimize the losses, because that also helps protect our revenue stream. So we're sitting on the same exact side of the table as our clients here.
Great, thanks. And we're just about out of time, but I had a question, and that is,
please.
But I have a lot of friends who are kind of doom scrolling the news, and they're very worried about what's going on in Congress with regard to the debt ceiling and the budget. So how nervous do we have to be from an investment standpoint about what's going on there?
Well, that's a great question, and that's obviously one of the biggest wild cards that we are struggling with here at the firm on a day-to-day basis as well. It's from my vantage point, without getting political about this, it's just a shame to see that neither party can really come to any kind of middle ground on many topics at all these days. My view and our view generally would be that the debt ceiling is not something we need to be terribly concerned about. This has been an ongoing source of leverage for political gamesmanship for a very long time in our country. I think that both parties, understand fully that it would be a catastrophic situation if they did not address the debt ceiling issue when that comes up again in December. And I think whether it's, the Democrats having to go it alone here, which I don't think is a necessarily bad solution, or if at the 11th hour, the Republicans decide to jump on board and participate in that process, I think ultimately something will get done similar to what we just saw happen here in the last week, where Republicans kind of jumped on board at the last minute and said, okay, well, at least help suspend this, for the next couple of months. So I think that the debt ceiling is generally respected as kind of the third rail in terms of the impact it could have economically, globally at this point, because so many things are tied to U.S. Treasury bonds and the credit quality and the full faith and credit behind U.S. Treasuries from the federal government. That's a line that just should not, and I don't think will be crossed. Now, on the spending side of things and the various fiscal packages that have been proposed, we're a big believer that this economy could use further fiscal stimulus, given what we've gone through and as resilient as this economy has actually been during the pandemic. And now I think there you get into more partisan issues of, well, how much is enough? From our vantage point, the one area that they should not be monkeying with in Washington is infrastructure spending. This is a key building block to the continued ability for our economy to continue to grow, to innovate, and to be one of the leaders around the world. And we've got crumbling roads, bridges, tunnels, et cetera, in this country, electrical grid. These are basic services and issues that we need to address now that unfortunately Washington has kicked that can down the road for really the last 50 years in this country. So to get the $1 trillion infrastructure package through, in our view, at the very least, is something Washington should be able to come to terms with on both sides of the aisle and get done. This economy in this country badly needs it. Now, when you get into the $3.5 trillion or $2.5 trillion or $1.5 trillion or whatever might be spent on other social services, I think there are some very strong arguments to be made that at the very least, some of the social support systems that are in place, particularly shoring up Social Security and Medicare, really need to be addressed, because these are issues that are going to have a significant impact on millions of Americans if they are not addressed over the next 10 years. And many estimates show that Social Security and Medicare trust funds essentially run out of money somewhere in the mid 2030s. And that is a social safety net that generations now have come to depend upon. I think we have a duty, as a society, to continue to provide for those folks in retirement and those that aren't able to work. And so my hope would be that, something gets done on that front as well. And I think that all of that additional stimulatory spending would be very helpful given where we are in dealing with this pandemic and this portion of our economic cycle right now.
All right. Well, thanks, Chuck. We'll take your investment tips to heart, I'm sure, and get started with our research.
Thank you so much.
Yeah,
Well, I
right.
certainly appreciate the opportunity to be here today, and thanks for all the wonderful questions. And, again, for anybody that has any interest, certainly please don't hesitate to reach out to us directly. We'd be happy to talk to you.
All right. Thanks, Chuck.
Thank
And
you.
thanks for joining us, to all of you there. Our next week on October 21st, our topic is protecting yourself from fraud and financial scams. And our speaker is Antonia Villasenor. She is Education and Outreach Coordinator for the California Department of Financial Protection. So if you haven't already registered for that or our final seminar on leaving a lasting legacy, you can do that at saclivefriends.org or at saclibrary.org. Money Matters. Thank you very much for joining us. We'll see you next week.